morning, good afternoon. This is Rob Barnett. I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On the call today, we've got starting over in his usual perch from Dubai, we've got Salih Yilmaz. Swinging over to London, we're joined by our associate Darja. Lema. Then down in Madrid, we've got Patricio Alvarez. And then swinging across the US, we've got Mike McGlone here in Florida with me, except down in sunny Miami. Mike, I think we're going to come to you first this week. It's been a pretty wild ride, just generally in the markets. I know on Monday, most of my screen on the terminal was red. I think there were very few items in the green on Monday, and we saw a pullback in equities, commodities, just really everything across the board. So I'm curious if you have any readout of what happened over the weekend, kind of early start of the week. And just looking at my screen today, we've seen Brent recover a little bit. We're about $78 and change. Give us your sense, though. What's the market shaping up, and kind of how are you seeing some of the near-term drivers play out?
It's the equity market starting to figure out that the global market, the world's tilting towards to a deflationary period, reciprocal to and worthy of the inflationary period we had to the peak in 2022. And it's just getting started, particularly if you watch commodities. The Bloomberg Industrial Metals Index was up 24% on the year. Now it's down 2%. On a one-year basis, the best performing commodity, major commodity, is gold. It's up 24%. I expect that to continue. To me, it's all kicking in. It's just a matter of time. WTI and Brent are both down almost 10% on a one-year basis. Corn, grains, natural gas are all down. It's just getting started, particularly if you watch things like the 10-year note yield in China, 2.14 or 14% this morning. U.S. 10-year note yield was 200 or so basis points above that. Now it's less. It's narrowing. It's all going that way. It's just a matter of time. It's completely normal. It's a normal cycle. It's questions what stops it. And I think the rise in U.S. unemployment is typically what is happening, is that recession that we didn't get last year, and then that the pendulum swung too far away from not getting this year. Is just starting to swing back to we are going to get the recession reciprocal to the inverted curve in the U.S. It's still extremely inverted. If you look at the 30-year yield at 4% or just above it, and Fed funds at 5.5%. Unemployment rates just starting to rise. It bottomed last year at 3.4%. It's 4.3% now. On a 100% basis since 1947, when it's bottomed from such levels, it always goes to 6%. And the key bottom line is just the deflation forces out of China are significant. So I look at crude oil, still one of the most elevated commodities. You know, you've heard this from me before. I've said it 2 years ago. I'll say it again. I don't think it really stops until you get WTI too cheap, which means below 50, probably 40, maybe even WTI. It's not profound if you just watch it, look at it for the last 20 years and what it's been doing. And natural gas has already done it. It's bounced. Corn is basically there. Copper has already started to rotate over. Industrial metals rotating over. I just look at what's going to stop this. The Fed's going to start cutting in September. And it was really entertaining. So what we got on Monday, I'll end with what we got on Monday was a pretty significant panic, a significant buy opportunity for traders, for tactically orientated who maybe hold for a few weeks. But what I really enjoy seeing is the minions all saying buy the dip, with the S&P 500 still extremely stretched above most of its moving averages. You got to at least get it to its 200-day moving average, which is another 6 or 7% below. And volatility in the U.S. The bottom line thing that really, I'll end up with the key thing that's mattering to me is volatility is just reverting higher. The one thing that helped me make a lot of money in 2008 when I was trading, I don't now, was that reversion in volatility. U.S. stock market volatility dropped to its lowest level ever. If you look at the VIX, and we're just bottoming from a similar level now. Back to you.
Yeah, okay. So I'm curious, do you think that, so you mentioned you think Fed rate cuts are coming. What's your read on kind of where rates go over the next 6 to 12 months? And, I think there is always talk of like this feedback loop between U.S. interest rates and commodity prices. How are you thinking about those two items here at the moment?
Well, that's a wonderful thing I remember from being before we had functions on a terminal like WRP and Fed Fund futures. You can just go where the market says rates are going to be. And if you just look at January 2025, 4% is what they're expecting for Fed funds. But what's different this time is how we got here. Rates went up rapidly. They went up on the elevator, and typically they go down on the elevator. So what's reciprocal to that is unemployment's still high in the US. And the market cap to GDP of the US stock market is the highest in our lifetimes, except for certain periods. So that's all that really matters in terms of inflation. So stock market staying high keeps inflation buoyed and keeps the Fed vigilant. So right now what we're seeing is this little bit of volatility in the stock market. It's kind of, I think, what they want. And it's unique. You see what's happening in Japan recently. They hiked rates, and then just last night they pushed back a little bit on that when they saw the stock market collapse. So we're seeing, I think, normalization of very expensive risk assets. And I have to mention that because when you're sitting at your value at risk model and you see what happened on Monday, WTI was an outperformer. It only was down 1 or 2%. Crude oil was down 1 or 2% when the S&P 500 was down about 4%. So it's a good sign of a little divergent bottom in the market. But overall, what's happening is the Fed will cut rates, but they will be reluctant to do that. And it's a historical shift from the past because they cut rates too much earlier. We created way too much inflation. And now we've learned that lesson. And this is where we are. And we're in that space where the whole world's tilting towards a deflationary recession. Certainly, if you look at industrial metals and gold, and crude oil is kind of in the middle, and it just hasn't achieve that low price cure yet, which needs to shut down that massive excess of supply out of US and Canada and really help boost demand, which you all know is tilting lower now, particularly in China, certainly if you watch bond yields.
Fantastic, Mike. Patricio, let's swing over to you real quick, because I think there is a often thought fundamental relationship between utility performance and what's going on with interest rates. What do you make of what Mike just said, and kind of how are you thinking about the trajectory of rates in your outlook for utilities at the moment?
Sure. So you're right. That is a perceived notion that utilities are inversely correlated to bond yields. Sometimes that's the case, and on Monday it was partially the case, if that makes sense. So utilities were down on Monday. European utilities were down, but they were supported, or they held better than the broader market in Europe. And since you've actually seen the gap, the year-to-date gap between the broader market and European utilities have actually narrowed. We're talking about roughly 7 to 8% at the moment. In April, it was roughly 12%. So the performance gap has narrowed significantly. The valuation gap on a PE basis has also narrowed. So these, I would say, these are early signs of a tilt towards more defensive, sort of stable investments, because that's the narrative, right? That utilities have stable income. They will give you a decent dividend yield. So European utilities dividend yield on average is around 5 to 5.5% this year. So we think that there's a bit of an evidence of this sort of counter-cyclical tilt, or off risk, or risk off. That's what we've seen, but nevertheless, within the index, obviously there are utilities in Europe that are more exposed to shifts in near-term demand. So you have your energy retailers like Centrica, and power producers like Fortum and Ørsted, and sort of the growth stocks known as like Ørsted and EDPR. Those stocks did suffer, but you saw other companies, the ones that operate grids that have sort of this stable income outlook, like National Grid, and Terna in Italy, they sort of performed better and have recovered significantly since that dip on Monday.
Okay, fantastic. Thank you, Patricio. Salih, let's swing over to you. I'm curious to hear your read on the interplay between rates, macroeconomics, and oil price. And also, I believe Aramco reported the other day. So tell us what you heard from them, and kind of how you're thinking about them for the remainder of 2024 and into 2025.
Sure. So I'll start with the macro. Looking at oil prices in the last week or so, on this call as well, we've always been talking about the price floor, perhaps, that OPEC Plus has been protecting, and we've been talking about an $80 a barrel price floor, I mean, we've gone below that, and I mean, I've heard some people on the terminal talk about a $75 a barrel price floor now, and we could soon be talking about a $70 a barrel price floor. I mean, when we look at what happened on Monday, as already mentioned, there was this wider risk-off sentiment, the global sell-off in financial markets, and this has impacted oil prices. And again, I mean, on the macro side, this is being driven by worries around an economic slowdown and the impact this could have on oil demand. And I do agree with Mike that when we look at demand across the globe, especially when we look at China, which is a very important and big part of the oil demand picture, we've been getting mixed signals, but some of the indicators that we got from last month, one being oil imports in China dropping to the slowest pace in almost 2 years, which is obviously a bearish sign. But then in the rest of the world, I mean, demand in the US has been pretty solid. We know in India, which is a very big importer of oil, demand has been actually pretty good. So, of course, oil has gone down, has gone below $80 a barrel for both Brent and WTI earlier this week. And there are some reasons for that. But I would say, and I would still argue, that there will be a price floor that OPEC Plus is protecting, because yes, OPEC Plus has come up with a plan to slowly start unwinding its cuts, but they are still very much keeping a tight grip on supply. They pretty much they still have an active supply management policy, and they can always kind of reverse that plan that they have for the fourth quarter if they need to, if oil were to fall even further. And very briefly on geopolitics, I know we've talked about it often, and at this point, no matter what might happen in the Middle East or with Russia, Ukraine, the market just seems very complacent about the risk. I think the market is just looking at whether there is any disruption or not. Just increasing geopolitical risk doesn't really seem to be pushing oil prices higher like it used to not that long ago. So just a couple of the drivers on the oil prices side. I just wanted to give my 2 cents. On Aramco, they reported yesterday. Very briefly on the results. I mean, it was a decent set of results. I think it was in line. Look at their bottom line. It was broadly unchanged. I think it was slightly lower. On upstream, I mean, across the peer group, what we've seen in upstream is that slightly better benchmark pricing. But the thing with Aramco is that they are directly impacted by the OPEC Plus cuts. Because of the OPEC Plus cuts, their output level is limited at just below 9 million barrels per day. I mean, this is obviously way below their production capacity of more than 11 million barrels per day, but they just have had their oil output stuck at this level. Downstream, I mean, we know refining margins were down sharply in the second quarter, and this was the case for Aramco as well. With chemicals, I mean, chemicals margins have been under a lot of pressure for a while now, but when we look at SABIC, where Aramco is the majority owner, they are still listed. They reported last week, and they actually reported a set of results that beat estimates. So there are some signs of improvement in chemicals. So all in all, a decent quarter. I think what was interesting for Aramco was what's always been interesting in the recent past has been their dividends. They have been paying a special performance-based dividend since middle of last year, which means they now pay a total dividend of about $31 billion every quarter. The interesting part there is that this is a higher number than the free cash flow they're generating every quarter. So it means that the net cash position that they've had for a while now, it's been reducing. This will flip into a net debt position as early as next quarter. So now the question is whether they extend these dividends into 2025. If they do, I mean, Aramco would have to be comfortable with a net debt position that's growing, with a gearing ratio that's growing. So those were some of the takeaways. I mean, there's a bunch of other stuff as well, but I don't want to take too long. Those were kind of the key highlights that we took away from the Aramco results yesterday.
Salih, I have to note, I'm gonna spit my coffee out because, you know, your quarterly dividend that Aramco is paying out is bigger than the market cap of some of the
Uh,
relatively
I,
large wind and solar names that I cover. So it just kind of
I,
made me chuckle a
yeah.
little bit.
One thing, if I could add very briefly, is I should say that a big portion of that dividend is going to the government. And I mean, one thing, I mean, they're in a position now where there might be some pressure for them to extend these dividends into 2025, even if it means a growing gearing ratio. And that is because the government, the Saudi government, needs those funds for a lot of those ambitious transformation projects that they have at home. So just a short
Fantastic.
note there. Yeah.
Okay, thanks, Salih. Let's swing over to Darja. Darja, very happy to have you on the call. I know you've been on at least once or twice before. And I want to get your input into the conversation along two lines. One, um, Solly was mentioning geopolitics, but he didn't mention Venezuela. And at least from my X feed, there's been a lot of activity there over the last little while. And I'm not following it super closely, but I'm curious if you have any readout on that. And I would just note you've got a very interesting piece of research out just from Aug 1st that looks at the role that Latin American E&Ps are playing generally in helping to keep sort of OPEC in check a little bit. So, yeah, tell us about Latin America in general, and if you have a comment on Venezuela, I'd be curious to hear it.
Absolutely. Thanks, Rob. Happy to be back. Yeah, so Salih mentioned quite a bit on the demand outlook for the world. I kind of want to look at the supply part of the equation. So Salih and I published an interesting note on Latin American's oil boom that we believe leaves little room for OPEC plus tapering. So our take here is that Latin American oil boom is helping to drive global supply growth in 2024 on top of the US and the Canadian production, putting pressure on OPEC to extend their cuts beyond the Q4 that they are supposed to be easing those out. As OPEC continues to face rising external supply and demand, as Salih was mentioning, remains fairly tepid. So the supply boost is largely driven by Brazil, Guyana, and as well as Venezuela, which you've mentioned, where production has been steadily growing over the last 4 years. So on the Venezuela side, very briefly, we did have an election a couple of weeks back. President Maduro was elected for the third term there, which means that probably the US sanctions are not going to go away anytime soon. However, the production in Venezuela has been growing steadily for the last 3 or 4 years with an average growth rate of about 13%. So it has been steadily growing, steadily normalizing. It's nowhere near where it was in 2020 when I think it was 3.5 million barrels a day, but it is steadily growing, and we estimate that it might reach 1 million by the end of this year. On Brazil, so we believe that Brazil could add above 200,000 barrels of oil a day because we calculate their output capacity could reach 3.7 million barrels of oil this year and surpass 4 million in 2025, as 3 major new developments offshore are expected to come online next year. We do note oil volume did fall 4% early this year, affected by a combination of maintenance work, labor strikes, and natural field decline. However, the decision by Petrobras, Brazil's national oil company, to fast forward the production start of one of their developments to Q4 from 2025 provides scope for high single-digit growth this year for Brazil. And lastly, very briefly on Guyana, Guyana has become one of the fastest growing oil producers globally since its first commercial production in 2019 and is on track to grow its production to 1.3 million barrels a day by 2027, which would place it ahead of several OPEC members, including Libya and Venezuela. Year to date, they've done about 645,000 barrels a day, all from the offshore Stabroek block, and is on track to add about 200,000 barrels a day this year. So the combined production from these three key countries promises to extend the continent's, Latin America's, global share supply to 7 to 8%, which we deem is a sizable to add pressure to OPEC, which OPEC is already facing from the external supply. And very briefly on LatAm earnings as well. So if you asked about their involvement, so most of the LatAm E&Ps, exploration production companies that I cover, are based in Colombia, whose production has an internal decline. So the midterm prospects for the E&Ps in Colombia are not great, as they continue to face multiple headwinds. The resurgence of social unrest in the first half of the year, burdensome regulatory landscape, and the rising tax base continue to put pressure on the oil producers and raise our concern over their midterm prospects. In the first half of the year, we did not see any guidance downgrade so far, yet the performance of several E&Ps points to the achievement only of the low end of guidance, such as Parex, Frontera, and Canacol. The latter two I expected to report this week, actually, so very exciting to watch that. However, overall, still strong oil price backdrop in Q2 signals that EBITDA generation and profitability should remain relatively strong for the group.
Okay,
so
fantastic.
That's all for me.
Thank you so much. Mike, I want to get your reaction to a little bit of the geopolitical conversation. You know, we've heard a little bit about Venezuela. Salih mentioned Israel-Hamas tension. He mentioned Russia-Ukraine. What do you make of the geopolitical stuff? You know, I know you've got a relatively bearish view on kind of where oil could go over the medium term here. And so is there something that could change your outlook, and would it be these kind of geopolitical factors?
Obviously, it could be. I was quite fluent. I was trading actively in 1990 when Saddam Hussein invaded Kuwait. That was a tremendous trading opportunity. Crude went from 20 to 40, back to 20, and bottomed at 10 a few years later. Same thing when Iraq and Iran were at it. It went up to 30, back down to 10. I mean, if the history of invasions like Russians invasion Ukraine is an example, we're going to get cheap. Now, what's happening in the Middle East right now, yes, if there's a major significant cut from supply in a major producing country other than Iran, sure, it's going to have a short-term blip in prices. It'll create a global recession, make prices go lower. But what's happening with Iran crude? It's going to China. You could tell me otherwise. And as we were speaking, I just had to double check the latest. OPEC is becoming less and less significant on a daily basis. I checked the latest. Right now, it's about 26% of global crude oil production. At the peak in 2008, it was around 38%. We see that trend there. The thing that's really happening now in crude oil is becoming redundant. And also what Darja really pointed out is what I'm hearing is a high price cure. The average cost of production in this country is around $55 a barrel. In Canada, it's around 60. Until you get below those levels, we're going to have that excess supply versus demand increase. And then the technology is increasing so rapidly. So geopolitics have to have a significant cut in supply, and they're not doing that. In fact, it's aggravating the existing trends that push crude oil lower in the first place. And that said, excess of supply out of US and Canada. And then we also have this repression. China's heading to a severe normal recession, depression, worthy of a rapidly advancing emerging market country that has decisively enabled a war in Europe, according to NATO. It's just get me out of China. It's happening exponentially. I can't wait to write the history books about it, but you have to focus on the macro right now. And it's so significant. And the bottom line is the U.S. stock market has to stay elevated. It was up 20% on the year so far for a little while. Now it's 12%. If it gives back more of that, everything is going to go down. It's just going to follow the example we're seeing from industrial metals. And crude oil is the one that's still elevated. Why is it elevated? Because what Salih mentioned, geopolitical tensions. But that'll go away unless it really cuts supply. That cut in supply will create a global recession. But unless there's a real definitive pickup in demand, prices are going to do what they always do. And the lessons of Adam Smith go their marginal costs. And I pointed out those levels.
Patricio, let's let's hear your view on the gas market over in Europe. It's been a while since we've got a check-in from you. It looks like TTF is about 37 euros a megawatt hour right now. Give us your sense on kind of, are we still in a gas crisis? Kind of how you read the tea leaves on gas right now.
Sure. So I think yeah, it's good to follow Mike's comments on this. I think our view in summary is that if you exclude any actual supply disruptions, which at the moment there is a lingering geopolitical premium on gas prices, I think. And now that you mention it, yeah, TTF prices are up to 38 euros per megawatt hour. That's about 4% just up this morning, and that's just on news that that a transit post in Russia was occupied by Ukrainian forces. Now that doesn't mean that gas flows will ease. The residual gas flows. There's a contract or transit agreement that runs through the end of 2024. I think there's a lot of chatter about how those flows may cease, but if you read the small print, they would still be able to book gas. They just don't have a long-term transit agreement. That doesn't mean that they cannot book gas, and there's only a handful of buyers in Europe that still buy Gazprom's gas. So looking at the fundamental impact of such a cut is not really that fundamental. It's maybe 2 to 3% of the price handle we have now. And looking sort of at the more far-reaching risk, or let's say the distant risks, is perhaps a real disruption in the Strait of Hormuz, which would impact LNG transit from Qatar and Saudi. That could be fairly material, but that's another story that would probably dislocate gas markets across the globe. But as I said, that's sort of a distant risk, because that involves perhaps a very intense escalation of the conflict in the Middle East. Aside from those, let's say, scenarios, the fundamentals for gas are relatively poor, I think, for the rest of the year. Gas demand is roughly is down another 8% in the first half of 2024, which is significant considering that it declined 14% in 2022, it declined 7% in 2023, and it keeps declining. And at the same time, you've seen an increase in renewable power supply. Obviously, that is sort of supported by higher hydro volumes, which we cannot control. But let's say on the underlying level, the renewable capacity for wind and solar has increased again, and that is also meeting a lot of that demand and displacing the demand, we think, structurally for gas. So that makes the outlook for gas demand pretty poor for the rest of the year. Industrial demand, which is, let's say, it puts sort of Germany in the spotlight, because Germany is the major exporter of goods to China. So if industrial demand in Germany does not pick up, and we think there's very little signals for that in the second half, we don't see much support for gas demand in the second half of 2024. So we think actually that the price right now has actually layered a bit of a geopolitical premium, and perhaps fundamentals suggest that its prices should be closer to 26 euros per megawatt hour. That's according or based on our proprietary fair value model, which we ran late in July. So it's still fairly recent, and I think fundamentals indicate that 26 euros per megawatt is more of a fair value.
Yeah, okay. Salih, I want to bring you back into the conversation. And so Patricio just made the case about, pretty bearish demand fundamentals for gas in Europe. And so maybe we're in this world right now where, at least in the US, I think gas is this bridge fuel, and we're seeing gas reach all-time highs in the power sector in terms of generation. We're almost seeing the opposite in Europe. Europe's decarbonizing, prioritizing renewables. And I don't want you to weigh in on gas, but I'm curious, in the oil market right now, are we seeing some of these energy transition pressures start to impact the demand picture in your view? Is Aramco talking about that? Because I know there's been this dueling battle between OPEC and IEA about the future of oil demand, and and we're constantly getting new data points and updates. So kind of what's your sense on where we're headed in both the near term and medium term on the global oil demand picture?
Sure. So, and by the way, I do agree that this agreement in both short-term and longer-term view between IEA and OPEC is quite something. Because I think we discussed it on this call last month as well, where even for this year, IEA thinks oil demand growth will be about 1 million barrels per day, and OPEC thinks it's going to be more than double that. And, you know, I mean, we're already more than halfway through the year, and it's just so striking to me that there is such a big difference. And also, longer term, IEA thinks oil demand will peak in around 2029. OPEC thinks oil demand will keep growing all the way until at least 2045. So, and you know, there is that famous chart of all the scenarios of where oil demand might be by 2040 or 2050, and it ranges from down at 60 million barrels per day to 150 million barrels per day or something like that, which is just so crazy. So, I mean, the moral of the story is that no one really knows. But I think, and to your earlier part, earlier part of your question, yes, we are starting to see striking differences in different regions as well. I mean, look at Europe and where oil demand is expected to be. And this is not necessarily just for IEA, but I was just looking at the IEA numbers. They're already expecting oil demand in OECD Europe to be slightly lower in 2025 than 2024. And I don't think this is a big surprise. The drivers of oil demand we know are going to be the growing parts of the world. It's going to be China, it's going to be India, it's going to be other emerging countries in Asia, other emerging countries in the rest of the world. And of course, there is the energy transition things that we're doing that is going to eat up from oil demand to an extent. But as we always say, you know, there are other things like the growing petrochemical sector, taking up a bigger chunk of the lighter end of the barrel for oil demand. So, you know, as I said, even IEA thinks oil demand will keep growing all the way to 2029. From there on, we will just have to see what's going on with fuel efficiency, how much fuel efficiencies are taking away from oil demand, adoption of EVs, which we know are accelerating. And it's not only a Norway story anymore. I mean, we know it's accelerating in the rest of Europe. Probably way more importantly, it's accelerating in China. And that's probably a trend that's going to continue. So, yeah, so in Europe, oil demand is expected to be lower next year and probably the year after that and the year after that. But that's not a huge surprise. I think the growth in oil demand is expected to come from other parts of the world anyway. So I'm just trying to remember if there was anything else in your question that I haven't answered. But anyway, there you go.
All right. I think we are running over on time. Maybe just quickly from me in the energy transition world, I feel like I would be missing a big theme if I didn't speak about it. So for those following the solar space, we had some pretty big news on Monday. SunPower filed for Chapter 11 bankruptcy. And if you're unaware, SunPower is a residential solar developer here in the U.S., and their main owner is Total Energies, over European energy major from France. Here's I think the general way to kind of think about this. One is the residential solar business it's not been a great business. It's when you think about the value chain of the solar space, I think that's the one piece where the business model is still kind of in development in some sense. You know, how can companies actually make money when a big part of their business is getting folks out up on ladders, up on roofs, and doing the work? It's you know, it's not something that scales maybe as well as other businesses. And then I think there's some read across into the sort of two large remaining players. And so Sunrun, they actually reported earnings yesterday, and then Sonova. Those are the other two big residential developers in the U.S., and the demise of SunPower perhaps gives them an opportunity to pick up market share. But I do think that there are sort of lingering questions just generally in this space about, okay, how do you actually make money in the residential solar business? And it's very reliant on tax credits here at the moment. So definitely be keeping an eye towards the election in the fall, because that somewhat plays into kind of how these companies generate cash if they are fortunate enough to be doing that. So reach out to myself if you want to talk at all about the ongoings in the solar space. And for everyone on this call, whether it's Mike, Darja, Patricio, Salih, myself, we're all green dots on the terminal right now. So shoot us an IB if you want to follow up on any of these topics or talk about any of the companies we cover or any of the research we've discussed here today. I would highlight that we do have a few upcoming events. Patricio, I don't remember the date, so I'm actually going to have you speak. What day is our IRA webinar? I think it's next week, but what's the day?
Yeah, Tuesday, August 13th. Tuesday the 13th.
So please, everyone on this call, I think you'll enjoy that. Patricio, myself, Nikki Sue, our counterpart who does utilities in the U.S., and a few others, Nathan Dean, I think our policy guy, we'll all be joining to go a little deep on the election and what it could mean. The other thing that I just want to flag for you is if you're based in Texas, if you're in the Houston area, September 10th, we've got an in-person event there. We're going to really hone in and talk about the intersection of AI and energy demand. Myself, Vince Piazza, Talon Custer, some of the regulars from this call will be there, but we've also got some really cool external speakers. I think we're waiting on a little bit of final confirmation before we announce who those external speakers are. But if you're really interested in this theme around LLMs, data centers, generative AI, and what it could mean for energy, you're going to want to be at this event. So reach out to any one of us and we'll make sure that you've got the details on how to join us there. So again, thank you for your time, and we look forward to talking to you next Wednesday, same time, same place. Take care, everyone.